Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 18th November. Coming up on the show, Bitcoin falls below $90,000. I've been talking to a top executive at one of the world's largest chip companies, and some signs of consumer weakness after Home Depot results disappoint. So grab your coffee and let's own the morning. Okay, we're going to focus on markets. Let's start with crypto. Bitcoin fell below $90,000 in Asia trading earlier. However, it has recovered somewhat since then. After a bruising session on Monday, US stock futures are pointing in the red again, but losses have eased. Global markets are also faltering. In Asia, Japan's Nikkei had its worst day since April. Now, Bitcoin's sell-off in the past month has been dramatic, and all of its 2025 gains have firmly been erased. In fact, in the options markets, traders are making more and more bearish bets against the biggest cryptocurrency. This decline in Bitcoin's value has coincided with a tech sell-off too. Talk of an AI bubble is clearly weighing on sentiment, and concerns over sky-high valuations don't seem to be easing. In an interview with the BBC, Google's boss Sundar Pichai said no firm would be unscathed if the AI boom collapses. And that's why the markets will be laser focused on Nvidia's results that come out after the closing bell on Wednesday. Another big factor weighing on the markets is what the Fed will do in December. The probability of a Fed rate cut still stands below 50%. That's according to the CME FedWatch tool. And this too has also clearly dampened the mood on markets. Now, the data now shows that there is a clear link between Bitcoin and equities. Well, Dirk Willer, head of macro strategy at Citi, explained this link to my colleague Josh Lipton.
It's interesting, actually, that when the equity market was still doing really quite well, we noticed the divergence with Bitcoin, and it's actually somewhat rare. So Nasdaq and Bitcoin both trade with a positive correlation, and you had episodes in the past where Bitcoin diverged to the downside, and that was at times a negative harbinger. So we backtested that, and we found actually it's fairly reliable. So if Bitcoin trades below its 55-day moving average, the information ratio of the Nasdaq is just 0.5. If it's above, it's 1.5. And of course, both are positive numbers because we essentially were in a bull market for a long time. But there's meaningfully better performance for the Nasdaq when Bitcoin is essentially part of the bullish sentiment rather than when it's diverging.
So in your note, Dirk, correct me if I have this wrong, we're trying to find explanations for what's going on with Bitcoin. Were you pinning that on tightening liquidity?
That is one of the explanations. There are a couple of things going on in Bitcoin that are interesting. First, there was a flash crash in early October. And that, for Bitcoin itself, it was a 14% move down over 2 days. Maybe not that drastic, but some of the altcoins really got sold much harder. And after this flash crash, we saw that the flows into the Bitcoin ETFs and so forth really changed. So the flows really never recovered, and so retail was apparently somewhat shell-shocked by that day, and we saw outflows. The other thing that happened is that I think a lot of the institutional investors trade Bitcoin with a bit of a trend-following mindset, and so we broke some of the moving averages that they tend to look at, and that is also reducing the source of demand. But the third point is what you were mentioning, and that is that the liquidity which we measure by bank reserves on the Fed balance sheet, dropped by a bit more than 500 billion. And that happened because the Treasury increased the Treasury general account at the Fed by selling a lot of T-bills. And there were two reasons for that. One is why this TGA account was so high. One is that that during the government shutdown, the Treasury didn't spend as much, so that account rose mechanically on the back of that. But secondly, they did sell more T-bills than is typical, and so we are thinking going forward, the liquidity squeeze, so that explanation for the Bitcoin weakness should actually get much better because we expect TGA to at the very least flatten out and probably decline, meaning bank reserves and liquidity should improve between now and the end, partly because of the reopening and partly because the Treasury sold so many T-bills already.
Well, the first thing you need to know is that Fed policymakers, well, they're not singing from the same hymn sheet when it comes to future Fed rate cuts. On the one hand, Fed Vice Chair Philip Jefferson said on Monday that the US central bank needs to, quote, proceed slowly. But on the other hand, Fed Governor Christopher Waller supports cutting interest rates next month because he's worried about the weakening job market. Well, later today, we also hear from Fed Governor Michael Barr, so keep tuned to that. All right, the next thing you need to know is about AI valuations again. Now, Databricks is in talks to raise funds at a valuation above $130 billion. That's according to the information. The data analytics firm helps users ingest, analyze and build AI applications, and many see it as a leading candidate to actually go public. Now, the latest valuation would be 30% higher than when it closed a $1 billion funding round just back in September. And the last thing you need to know is that we have more earnings out this morning. The first big box retailer to report this week is Home Depot. It reported weakening sales growth and cut its outlook for the financial year. It blamed a downturn in its performance on a sluggish housing market and weaker consumer sentiment. The world's largest home improvement chain saw sales rise just 0.2% in Q3, and unsurprisingly, shares fell in the pre-market, down there over 3%, as you can see. Well, we'll also hear from other retailers later in the week, including Walmart and Target, so keep tuned to Yahoo Finance for those results. Okay, we're heading for a short break now, but when we're back, we'll hear from one of the top executives at Arm Holdings. Welcome back. Well, and AI is our focus once again. Well, besides NVIDIA, there are only a few other big players in the chip making space that dominate the market. Arm is one of them. I spoke with Ami Badani, the CMO of Arm, about the company's strategy to seize the AI opportunity. Take a listen.
If you remember, just 2 years ago, we had just gone public. We are now almost double our revenue from when we went public. A bit of more detail on that. We had $620 million in revenue in terms of royalty revenue. That's a double-digit 21% year-over-year royalty growth. And that's a big shift because of our business model has evolved from traditionally designing, focused on licensing IP, to now focusing on compute subsystems. And compute subsystems has really driven a lot of demand for customers that are interested in driving time to market for their AI chips and really driving improved time to market and de-risking their engineering investment.
You spoke there about a shift in strategy. I mean, I think Arm has always been known for, its CPUs, which perhaps may have seemed in these days a little bit old-fashioned. So in 10 years' time, what will we know Arm Holdings for?
I think what you'll probably know the company for, so if you remember, 30 years ago, what we were predominantly known for is powering mobile devices. That was sort of the start of the early days, mobile devices off of batteries. Apple Newton being the first example of that in the very early days. Unfortunately, Apple Newton never came to market, but what it gave us is a really good proof point that you could run smartphones off of batteries. And so now, fast forward to where we are from a company perspective, we're pretty much in every single device. We have 325 billion devices with ARM technology. And that spans from edge AI, which includes mobile, PCs, industrial automation, home automation, wearables, to physical AI, which is automotive and robots. And then also, cloud AI, which is all about data centers. And so you mentioned what will you see ARM? I think you'll see ARM everywhere in the future decade. It will be powering everything from the smallest of devices to the largest of data centers. I think over time, what you'll see, there's a lot of talk about data center spend and how most of the AI spend is really in the data center. But like all technology trends, a lot of that compute will be distributed. So over time, what you'll end up seeing is AI evolve from not just running in the data centers, but also running in the smallest of devices, closer to the end user for privacy reasons, security reasons, latency reasons, and ARM is everywhere. So that's kind of what you'll see over the next decade.
How will ARM actually satisfy this sort of ever-growing demand for computing power?
Yeah, I think, if you look at where ARM, the focus of ARM has been, it's really been about power efficient compute. We talked about mobile in the early days. And that really stems from power efficient compute. And now you look at data centers and the kind of the key underlying trend that you need in the data center is power efficient chips. And so you think about ARM is designing power efficient chips for the data center and outside of the data center. And so that really goes to back to the kind of the ethos of the company, which has all been around power efficiency. I like to talk about something called intelligence per watt. And, as we need to move to intelligence and more intelligence driven by AI, whether that's to accelerate scientific breakthroughs, whether that's for climate change, for productivity, for GDP growth. But for us to do that, you really need to get into you need to have the most power efficient compute to be able to drive the intelligence in the future, super intelligence in the future. So when you think about, how much more compute can you put into that same watt envelope, ARM is really the answer to that.
Now, apart from data centers, which other areas, which other devices actually do you see potential in?
Yeah, I mean, I think what, AI is really everyone is thinking about every device in terms of AI. And so we've introduced a number of technologies, mostly matrix extensions at the edge where you can run on-device AI. So many of the handset manufacturers that you'll see over the next quarter, you'll start to see them run AI locally on the device. So that's just one example of smartphones. I think home automation systems, industrial automation, all of that will be AI enabled in the future. I think some of the workloads will run in the cloud, and a lot of those workloads will run on the edge, whatever those devices may look like. I also think there's going to be a new class of devices that may stem up from these AI workloads that we don't even know what they look like or they don't exist on the market today. So there's going to be a whole new class of devices that will be powered by AI in the future.
And Ami, are you not worried? There are growing worries about an AI bubble. What do you say to those people who are worried about that?
Yeah, I think that's an interesting question and one that many are pondering. And so the way that I think about it is, I look at where we are with AI today. And I think we're just scratching the surface in terms of where we need to get to with acceleration of science, of climate change, of human productivity, of GDP growth, et cetera. And so if you look at where we are today to where we need to get to, I think we're nowhere near the compute capacity needed in order to be able to get to the insatiable demand that to drive AI of the future in terms of all the intelligence that we need in the future. So, if you look at, there's some similar constructs to the internet bubble, which is what people are referring to when they think about the AI bubble. And when you look at the dot-com boom, there were many great companies that came in the dot-com bubble, Amazon being one example. Now you look at the AI boom, as I like to say, and I think we're nowhere near the compute capacity that we need to fuel the next generation of AI. So I don't actually think we're in an AI bubble. I think, we're just getting started of where we need to go. And I believe AI will be everywhere in the future.
Remember, stay locked in to Market Sunrise for key insights from global financial leaders. All right, it's time for another break, but we'll be back soon with today's trending stocks, and you won't be surprised, there's some big moves to watch. It's time now for today's trending tickers, and we need to look at some of the stocks before Wall Street opens, and it's not just crypto that's dominating, but we do start with a crypto one. First up, Coinbase. The crypto exchange is under pressure again after Bitcoin slid below $90,000 overnight, wiping out its gains for the year and extending an early 30% drop from its October peak. Now, Coinbase's shares closed over 7% lower on Monday, and they're edging lower again in the pre-market. The stock's fate is clearly tied to whatever happens next in crypto. Next, the buy now, pay later giant Klarna is posting its first earnings report since its September IPO on the New York Stock Exchange. The shares closed up around 1.8% before giving back a little in after-hours trading. The stock is down nearly 24% since its debut on Wall Street, and today our analysts are looking for double-digit revenue growth, but still expect a net loss as Klarna invests heavily in expansion. With regulators watching closely the buy now, pay later space, today's numbers will be a key test for the Swedish lender. Now, if you're a sports buff, you know Arc'teryx, Salomon, or the tennis gear from Wilson. Well, the owner of all those brands, Amer Sports, just beat earnings predictions this morning, continuing its strong growth on almost all fronts: revenue, margin, earnings per share. And investors are loving it. The stock is up more than 8% on that impressive beat, helped by direct-to-consumer sales and upmarket positioning in the premium segment. Now, a quick word on another stock that's soaring, Axalta. There's a big deal in the paint and coatings world. Axalta and Dutch rival AkzoNobel are combining in an all-stock merger of equals, worth more than $9 billion. But what we are seeing is a tale of two stocks. Akzo is down and Axalta is up more than 7%, as you can see. This deal creates a global giant in automotive and industrial coatings. And finally, Lockheed Martin is in focus today after President Trump said he will approve the sale of its F-35 fighter jets to Saudi Arabia. Now, Lockheed shares closed around $471 last night, up just over 1% on the day, but no big moves this morning, at least for now. Now remember, today the Prince of Saudi Arabia, Mohammed bin Salman, will be in Washington. Expect more news from there. Okay, so we've heard from Home Depot earlier, but Walmart and Target are also reporting. Here's Jessica Ramirez from the Consumer Collective on what to watch in Q3 retail earnings.
Walmart and Target both set to report third quarter earnings this week. Investors will be listening closely to see how much consumers are spending and for the holiday shopping outlook for both companies. Here with more on what to expect from these results and how consumers are holding up, Jessica Ramirez is here with me in the studio. She's the Consumer Collective co-founder and managing director. Thanks for being here.
Thank you for having me.
So we have these companies coming out this week. We've seen Walmart pretty consistently performing better than Target, although both of them are now going to be undergoing leadership changes, right? But what should we be paying attention to for these companies this week?
I think Walmart has the upper hand in a lot of this. They have been taking market share from Target for some time, almost a year really. I think they are well positioned. They have the high income consumer, which they've been taking advantage, and also evolving the rest of the category. So there's a reason for them to stay outside of just grocery. And they also have middle income and low income, where I feel with Target, they are still much more discretionary exposed, but at the same time, I've seen the store experience and also the product starting to dwindle, which again isn't really boding very well for them. And in terms of price sensitivity and convenience, I feel like Walmart is still the winner. And like I said, they've evolved across their discretionary categories. Beauty categories looking fantastic there. Their apparel is looking really good, and they've really been focused on that. And again, I think that's the advantage Target used to have, where now Walmart is that one-stop shop.
So what does Target need to do then? Like, what are you going to be listening for when they report earnings and have that conference call to help convince you that they're going to make progress in this area?
It's interesting to see where just last week, I believe, the weeks are going quite quickly, they talked about bringing down their price. But again, if I'm starting to see some of that quality dwindle, it's questioning, and I think they probably will be taking hits on their margin. I think that's part of where we're going to also see, even with Walmart, where our tariffs starting to hit. Again, Walmart does have the advantage of that higher end consumer and just coming in more. And they have the media arm, which is doing great for them. Also the marketplace, that's really ramped up for them in terms of partnership. But with Target, I think some of it needs to ramp up a bit more. And again, just questions around service and what that's looking like in store, because as they are letting go of people and they're going through this turnaround, I think it's going to be a bit tough in the beginning.
Okay, well, later today we get some mortgage data, so it's important that we have a closer look at the housing market. And here's Meredith Whitney talking about that just now.
One of the biggest problems is that over 60% of homes are owned by people over 60, and they're not moving. So they, by and large, own their homes full out, and for them to downsize, they're not getting much on a value basis for them to downsize. So they prefer to age in place. That keeps the market pretty gummed up. So there's even less inventory than there would be otherwise. There's obviously a shortage of housing inventory, but existing homes, there's a gummed up market, as you said, because people are aging in place. They don't want to sell. So one thing that I think is interesting, a couple of things have been floated over the last week, which is a 50-year mortgage, which doesn't make much sense to me, or a portable mortgage, which I'm not exactly sure how that works. But one thing that is encouraging is that something that was passed in the Senate Banking Committee over the summer in July, which is the Road Reinvention of the American Dream Act for housing. And so what it focuses is insofar of what the federal government can do, which is limited, which is, let's say, 20 to 30% of the pain. Most of it's a local problem, a regional problem, is getting rid of a lot of the red tape and encouraging funding programs and grant programs for the states that are really going to accelerate housing programs and build more housing. And there's a big emphasis on manufactured housing, which is over a quarter cheaper than the site-built, stick-built homes. And I think that's going to be a big way forward for housing, which is just build much more affordable housing and then get government programs to incent more opportunity zones and smaller lot sizes. There's a lot that can be done, and kudos to the bipartisan passing of the bill in the House Banking Committee. That moves then to the larger Senate and then the House. Obviously, the House Banking Committee is going to have to take a close look at it, but it looks pretty good, and I think that's probably a better step forward than what seems to be a quick fix, but not a very realistic quick fix in terms of a 50-year mortgage or a portable mortgage.
Why is a 50-year mortgage, in your view, not a good idea?
It doesn't really lower the cost. I mean, to me, you've got to do two things.
Doesn't it increase the cost? Potentially?
It doesn't. It doesn't necessarily lower the cost competitively for a 30-year mortgage necessarily. You're paying down a lot of interest. You're not paying down a lot of principal with that structure, and you're not building a lot of equity, which is what the American dream is all about. So if you look at seniors, I always go back to seniors, which again own 60+% of homes. 79% of them, 76% of them own homes without a mortgage. So they bought their home.
Okay, well, before we go, let's check in on the markets. We start with Bitcoin, and as we know, it slid below $90,000 for the first time in 7 months, and it's not starting pretty. It's still in the red, but slightly better than it was doing in Asian trade. Okay, let's move on to gold, and it's heading for another negative session. Remember, it's fallen for 4 straight sessions as the dollar has strengthened amid fading expectations for a Fed rate cut. Okay, Asian stocks now, and well, Asian stocks sagged to 1-month lows today, with heavier selling in Japan and South Korea's tech-driven markets. As you can see, they're both down over 3%. Now, in Europe, it's a similar sort of picture. All the main benchmarks open significantly lower at the open. There's renewed concerns over those AI-linked stocks. They're not going away. And how about Wall Street? And it's no surprises. Again, another sea of red. All eyes later this week will be on Nvidia's earnings and, of course, the release of government shutdown delayed labour data. Okay, that's it for Market Sunrise on Yahoo Finance. Stay tuned. I'm Ramzan Karmali. Go own the morning.